Question 1. A life insurance policy is said to have been assigned. If the policy owner makes an absolute assignment, which of the following statements is true? A. Only the policy's death benefit is transferred to the assignee. B. The policy owner temporarily transfers some of their policy rights to the assignee. C. All rights of ownership are permanently transferred to the assignee. D. The policy owner can regain full ownership rights at any time without the assignee's consent. Answer: C. All rights of ownership are permanently transferred to the assignee. An absolute assignment involves the complete and permanent transfer of all rights of ownership from the original policy owner to another party, known as the assignee. This means the new owner has full control over the policy, including the right to change beneficiaries, take out loans, or surrender the policy, which is a key distinction from a collateral assignment, where rights are temporarily transferred to secure a loan. For example, if a policy owner absolutely assigns their policy to their child, the child then owns the policy entirely. Remember that an absolute assignment implies a full, final transfer. Question 2. An individual applies for a life insurance policy and makes the first premium payment. The producer issues a conditional receipt. If the applicant dies before the policy is issued, which of the following is true? A. The insurer must refund the premium, but no death benefit is paid. B. Coverage begins immediately on the date of application, regardless of insurability. C. Coverage may be effective as of the application date, provided the applicant was insurable at that time. D. The policy is considered rejected, and the premium is returned without any further obligation. Answer: C. Coverage may be effective as of the application date, provided the applicant was insurable at that time. A conditional receipt provides that coverage may become effective on the date the application was signed or the date of the medical exam, whichever is later, but only if the applicant proves to be insurable according to the insurer's underwriting standards at that time. This means if the applicant dies before the policy is formally issued, the death benefit would be paid out if the underwriting process determines they would have qualified for the policy as applied for. This type of receipt protects the applicant by potentially providing immediate coverage while the insurer processes the application, making the condition of insurability the crucial factor. Question 3. Which of the following statements accurately describes the free look provision in a life insurance policy? A. It allows the policy owner to make changes to the policy's face amount within 10 days of delivery. B. It permits the policy owner to return the policy for a full refund of premiums paid, typically within 10 days of delivery. C. It provides a 31-day grace period for premium payments without policy lapse. D. It enables the policy owner to withdraw cash value without surrender charges during the first year. Answer: B. It permits the policy owner to return the policy for a full refund of premiums paid, typically within 10 days of delivery. The free look, or right to examine, provision gives the policy owner a specific period, typically 10 days, or longer, like 20 to 30 days for variable products or policies sold to seniors in some states like California, to review the policy after delivery and return it for a full refund of all premiums paid if they are not satisfied for any reason. This provision ensures the consumer has time to understand their purchase and provides a safeguard against impulse decisions or misrepresentation. Think of it as a cooling-off period for the policyholder to confirm their decision. Question 4. All of the following are typically considered settlement options for life insurance death benefits, except A. Fixed period installments. B. Cash surrender value. C. Life income option. D. Interest only. Answer: B. Cash surrender value. Settlement options describe the various ways a life insurance death benefit can be paid out to the beneficiary, such as in a lump sum, the default, fixed period installments, fixed amount installments, interest-only payments, or as a life income, annuity. The cash surrender value, however, is an option available to the policy owner while the insured is still alive, allowing them to terminate the policy and receive the accumulated cash value, which is not a death benefit payout method. Remember, settlement options are about how the death benefit is distributed, not how the living policy owner accesses funds. Question 5. The clause in a life insurance policy that prevents an insurer from denying a claim based on misstatements in the application after the policy has been in force for a specific period, usually 2 years, is known as the A. Grace period provision. B. Reinstatement clause. C. Incontestability clause. D. Entire contract clause. Answer: C. Incontestability clause. The incontestability clause states that, after a life insurance policy has been in force for a certain period, typically 2 years, the insurer cannot deny a claim or void the policy based on misstatements in the application, even if they are material, unless the misstatements relate to fraudulent impersonation or lack of insurable interest. This provision protects the beneficiary from future challenges to the policy's validity, ensuring claims are paid, and encourages insurers to complete their underwriting within the contestable period. Think of it as a time limit for the insurer to discover honest mistakes. Question 6. Which type of life insurance policy offers flexible premiums and an adjustable death benefit, allowing the policy owner to increase or decrease both? A. Whole life. B. Term life. C. Universal life. D. Variable life. Answer: C. Universal life. Universal life insurance is characterized by its significant flexibility, allowing policy owners to adjust both their premium payments, within certain limits, and the death benefit amount. This contrasts with whole life, which has fixed premiums and a level death benefit, and term life, which provides coverage for a specific period with no cash value accumulation. Universal life policies also feature a cash value component that grows based on interest rates and can be accessed by the policy owner. Its flexibility is a key distinguishing feature for consumers. Question 7. A policy owner has stopped paying premiums on their whole life policy. The policy has a substantial cash value. If they choose the reduced paid-up non-forfeiture option, what will be the effect? A. The policy will continue for the original face amount for a reduced period of time. B. The policy will continue for a reduced face amount for the same period of time as the original policy. C. The policy will be cancelled, and the policy owner will receive the cash value. D. The policy will continue for the original face amount, but the cash value will be frozen. Answer: B. The policy will continue for a reduced face amount for the same period of time as the original policy. The reduced paid-up non-forfeiture option uses the policy's accumulated cash value as a single premium to purchase a new, fully paid-up whole life policy with a reduced face amount. This new policy remains in force for the remainder of the insured's life, just like the original whole life policy, but without any further premium payments. This is different from extended term, which would provide the original face amount for a limited time. Remember, reduced paid-up means a smaller death benefit for life. Question 8. What is the primary purpose of the Medical Information Bureau, MIB? A. To provide medical treatment to insurance applicants. B. To act as a clearinghouse for medical claim submissions. C. To assist insurers in underwriting by detecting misrepresentations and identifying medical conditions. D. To conduct medical examinations for life insurance applicants. Answer: C. To assist insurers in underwriting by detecting misrepresentations and identifying medical conditions. The Medical Information Bureau, MIB, is a non-profit association that collects and shares coded health information among member insurance companies. Its primary purpose is to help insurers detect fraud and misrepresentations on insurance applications, as well as identify applicants who may have been denied coverage by other companies due to undisclosed medical conditions. The MIB does not provide medical treatment or conduct examinations. It serves as a valuable information exchange to ensure fair and accurate underwriting practices across the industry. Question 9. An individual receives an annuity payment that is partially taxed and partially considered a return of premium. This is consistent with which principle? A. the cost recovery rule. B. The exclusion ratio. C. The FIFO, first in, first out, rule. D. The MEC, modified endowment contract, rule. Answer: B. The exclusion ratio. The exclusion ratio is used to determine what portion of each annuity payment is considered a tax-free return of the annuitant's original premium, cost basis, and what portion is taxable earnings. This ratio is calculated by dividing the annuitant's investment in the contract by the expected total return. For example, if you put in $100,000 and expect to receive $200,000, 50% of each payment is considered a tax-free return of your cost. This rule ensures that only the earnings portion of annuity payments is subject to income tax. Question 10. Under a typical life insurance policy's suicide clause, if the insured commits suicide within the first 2 years of the policy's effective date, the insurer will usually A. Pay the full death benefit. B. Pay a reduced death benefit. C. Refund the premiums paid. D. Deny the claim entirely. Answer: C. Refund the premiums paid. The suicide clause in a life insurance policy typically states that if the insured commits suicide within a specified period, usually the first 2 years from the policy's issue date, the insurer's liability is limited to a refund of the premiums paid, without interest. After this 2-year period, the full death benefit would generally be paid regardless of the cause of death, including suicide. This clause aims to prevent individuals from purchasing life insurance with the intent to commit suicide soon after. Question 11. Which life insurance rider guarantees the insured the right to purchase additional coverage at specified future dates or events without proving insurability? A. Waiver of premium rider. B. Accidental death benefit rider. C. Guaranteed insurability rider. D. Cost of living, COL, rider. Answer: C. Guaranteed insurability rider. The Guaranteed Insurability Rider, GIR, is a valuable addition to a life insurance policy that allows the insured to purchase additional amounts of life insurance at predetermined intervals, e.g., every 3 years, or upon the occurrence of certain life events, e.g., marriage, birth of a child, without the need to prove current insurability. This means the insured can increase their coverage regardless of any changes in their health status. This rider is particularly useful for younger individuals who anticipate needing more coverage as their responsibilities grow. Question 12. A policy owner has an irrevocable beneficiary designation. Which of the following actions requires the consent of the beneficiary? A. Changing the settlement option of the policy. B. Taking out a policy loan. C. Assigning ownership of the policy. D. All of the above. Answer: D. All of the above. When a beneficiary is designated as irrevocable, their rights in the policy are vested, meaning they have a legal interest that cannot be removed or altered without their written consent. This makes it impossible for the policy owner to unilaterally change the beneficiary, borrow against the policy's cash value, assign the policy, or make any other significant changes, including changing the settlement option, without the irrevocable beneficiary's agreement. This designation provides the highest level of security for the beneficiary's interest. Question 13. Which of the following statements regarding a modified endowment contract, MEC, is correct? A. All life insurance policies automatically become MECs after 7 years. B. Policy loans and withdrawals from a MEC are subject to LIFO, last in, first out, taxation and a 10% penalty if taken before age 59.5. C. The death benefit of a MEC is fully taxable to the beneficiary. D. A MEC loses its cash value accumulation benefits. Answer: B. Policy loans and withdrawals from a MEC are subject to LIFO, last in, first out, taxation and a 10% penalty if taken before age 59.5. A modified endowment contract, MEC, is a life insurance policy that fails the 7-pay test, meaning it has accumulated cash value too quickly relative to the premiums paid. While a MEC still provides a tax-free death benefit, its primary consequence is the loss of the favorable tax treatment typically afforded to life insurance cash value. Specifically, distributions, including loans and withdrawals, from a MEC are taxed on a LIFO, last in, first out, basis, meaning earnings are withdrawn first and are subject to ordinary income tax, plus a 10% penalty if the owner is under age 59 and a half. This rule discourages the use of life insurance primarily as a tax-advantaged investment vehicle. Question 14. A deferred annuity typically begins making payments to the annuitant at what point? A. Immediately after the initial premium payment. B. Within 1 year of the contract purchase date. C. At a future date chosen by the annuitant, often at retirement. D. Only upon the death of the annuitant. Answer: C. At a future date chosen by the annuitant, often at retirement. A deferred annuity is designed to accumulate funds over time and then begin making income payments at a future date selected by the annuitant, which could be years or even decades after the initial purchase. This contrasts with an immediate annuity, which starts payments within 1 year, usually 30 days to 12 months, of purchase. Deferred annuities are commonly used for retirement planning, allowing assets to grow tax-deferred during the accumulation phase before converting to an income stream in the payout, annuitization, phase. Question 15. The payor benefit rider on a juvenile life insurance policy is designed to A. Waive the policy's premiums if the juvenile becomes disabled. B. Pay a lump sum to the juvenile upon reaching a certain age. C. Waive future premiums if the adult policy owner, payor, becomes disabled or dies. D. Increase the juvenile's death benefit automatically at certain ages. Answer: C. Waive future premiums if the adult policy owner, payor, becomes disabled or dies. The payor benefit rider is specifically designed for juvenile life insurance policies. It provides that if the designated payor, typically a parent or guardian who owns the policy, becomes totally disabled or dies before the insured child reaches a certain age, e.g., 21 or 25, the premiums on the juvenile policy will be waived until the child reaches that age or the payor recovers. This ensures the child's insurance coverage continues without interruption, even if the premium-paying adult is no longer able to do so. Question 16. What is the primary difference between a participating and a non-participating life insurance policy? A. Participating policies are typically sold by stock companies, while non-participating policies are sold by mutual companies. B. Participating policies pay dividends to policy owners, while non-participating policies do not. C. Non-participating policies have adjustable premiums, while participating policies have fixed premiums. D. Participating policies offer cash value accumulation, while non-participating policies do not. Answer: B. Participating policies pay dividends to policy owners, while non-participating policies do not. The key distinction between participating and non-participating life insurance policies lies in the payment of dividends. Participating policies, typically issued by mutual insurance companies, allow policy owners to participate in the company's surplus by receiving non-guaranteed dividends, which are essentially a return of excess premiums. Non-participating policies, generally issued by stock companies, do not pay dividends, their premiums are typically fixed and guaranteed. Dividends are not considered taxable income, as they are seen as a refund of an overpayment of premium. Question 17. The purpose of a viatical settlement is to A. Allow a terminally ill insured to sell their life insurance policy for a percentage of its face value. B. Provide a lump sum payment to beneficiaries after the insured's death. C. Convert a whole life policy into an annuity during retirement. D. Enable an insured to borrow against the cash value of their policy. Answer: A. Allow a terminally ill insured to sell their life insurance policy for a percentage of its face value. A viatical settlement allows a terminally or chronically ill individual, the viator, to sell their existing life insurance policy to a third-party company, the Viatical settlement provider, for a lump sum cash payment that is less than the death benefit but typically more than the policy's cash surrender value. This provides financial liquidity to individuals facing significant medical expenses or end-of-life care costs, while the Viatical settlement provider becomes the new owner and beneficiary of the policy. Question 18. An agent knowingly persuades a policy owner to lapse a policy and purchase a new one with another insurer for the sole purpose of earning a commission, resulting in the policy owner's detriment. This unethical practice is known as A. Rebating, B. Coercion, C. Twisting, D. Churning. Answer: C. Twisting. Twisting is an illegal and unethical practice where an agent induces a policy owner to replace an existing life insurance policy with a new one from a different insurer, often through misrepresentation or incomplete comparisons, and solely to the policy owner's disadvantage. The core detriment lies in the new policy typically having higher initial costs, new contestable periods, and potential loss of accumulated cash value or benefits. While churning involves replacing a policy within the same company, twisting specifically involves a change from one insurer to another. Question 19. When an insured dies and the beneficiary requests the proceeds be paid out over a specific number of years, this is an example of which settlement option? A. Life income, B. Interest only, C. Fixed period, D. Fixed amount. Answer: C. Fixed period. The fixed period settlement option allows the beneficiary to receive the death benefit in equal installments over a predetermined period, chosen by the beneficiary, such as 10 or 20 years. Both the principal and interest are gradually paid out until the fund is exhausted. This differs from the fixed amount option, where a specific dollar amount is paid out until the funds run out, or the life income option, which pays an income for the beneficiary's lifetime. Think of a fixed period as choosing a specific timeline for payment. Question 20. Which of the following is typically not a factor used in determining life insurance premiums? A. Mortality, B. Interest, C. Expenses, D. Policy owner's income. Answer: D. Policy owner's income. Life insurance premiums are primarily calculated based on three factors: mortality, the likelihood of the insured dying; interest, the earnings the insurer expects to make on invested premiums; and expenses, the cost of doing business, including administrative and marketing costs. The policy owner's income is generally not a direct factor in determining the premium rate for the policy itself, although it might be considered during the underwriting process to assess the applicant's ability to pay premiums or to establish insurable interest for large coverage amounts. Question 21. Under the Uniform Simultaneous Death Act, if the insured and the primary beneficiary die in the same accident and it cannot be determined who died first, it is generally assumed that A. The primary beneficiary survived the insured, B. The insured survived the primary beneficiary, C. The proceeds are paid to the estate of the primary beneficiary, D. The proceeds are split equally between the estates of the insured and the primary beneficiary. Answer: B. The insured survived the primary beneficiary. The Uniform Simultaneous Death Act is a legal provision designed to address situations where the insured and the primary beneficiary die at or near the same time, and there is no clear evidence of who died first. Under this act, it is legally presumed that the primary beneficiary died before the insured. This presumption means the death benefit proceeds will then be paid to the contingent beneficiary, or if none exists, to the insured's estate, avoiding the need for the proceeds to pass through the primary beneficiary's estate. This rule prevents unintended distribution of funds. Question 22. A policy owner decides to surrender their whole life policy for its cash value. What is the tax implication if the cash value received is less than the total premiums paid? A. The entire cash value received is taxable. B. The difference between the cash value and total premiums paid is taxable as a capital gain. C. The cash value received is tax-free. D. Only the interest earned on the cash value is taxable. Answer: C. The cash value received is tax-free. When a life insurance policy is surrendered, and the cash value received is less than the total premiums paid into the policy, the proceeds are considered a return of cost basis and are generally received income tax-free. Taxation only occurs if the cash value received exceeds the sum of premiums paid, in which case the excess amount, the gain, would be taxable as ordinary income. This is an application of the cost recovery rule, where you are simply getting your own money back. Question 23. An applicant misstates their age on a life insurance application. If this is discovered after the policy has been issued and the insured dies, what will the insurer typically do? A. Void the policy and refund all premiums paid. B. Pay the full death benefit as stated in the policy. C. Adjust the death benefit to what the premium would have purchased at the correct age. D. Deny the claim entirely due to misrepresentation. Answer: C. Adjust the death benefit to what the premium would have purchased at the correct age. The misstatement of age or gender clause in a life insurance policy states that if the insured's age or gender was misrepresented on the application, the insurer will not void the policy. Instead, upon the insured's death, the death benefit will be adjusted to the amount that the premiums paid would have purchased at the insured's correct age or gender. For example, if you stated you were younger and paid a lower premium, the payout would be proportionally reduced. This provision aims to ensure fairness by correcting the coverage amount rather than canceling the policy. Question 24. Which of the following accurately describes the interest-only settlement option for a life insurance death benefit? A. The principal death benefit is paid out in equal installments over a specified period. B. The beneficiary receives only the interest earned on the death benefit, while the principal is held by the insurer. C. The death benefit is converted into an annuity that pays income for the beneficiary's lifetime. D. The beneficiary receives the entire death benefit as a lump sum, along with any accumulated interest. Answer: B. The beneficiary receives only the interest earned on the death benefit, while the principal is held by the insurer. Under the interest-only settlement option, the insurer retains the principal amount of the death benefit and pays the beneficiary regular interest payments from that principal. The beneficiary can typically elect to withdraw the principal at a later date, either in a lump sum or in installments. This option is often chosen when the beneficiary does not immediately need the principal but wants a steady income stream, such as when planning for a child's future education or deferring principal access. Question 25. An insurer's practice of classifying an applicant as a higher risk based solely on their race or ethnic origin would be considered: A. Adverse selection. B. Discrimination. C. Substandard rating. D. Risk pooling. Answer: B. Discrimination. Classifying an applicant as a higher risk, or treating them differently, based solely on protected characteristics such as race, ethnic origin, religion, or national origin, is illegal and unethical discrimination in insurance. Insurers must base underwriting decisions on actuarially sound data related to actual risk factors like health, occupation, and lifestyle, not on arbitrary characteristics. While adverse selection describes a tendency for higher-risk individuals to seek insurance, and substandard rating is a legitimate classification based on higher risk, basing these solely on race is discriminatory.